Hello, ladies and gentlemen. I am Paul Welfens from the European Institute at the University of Bogota. We are starting now the class Macroeconomics and Global Financial Markets. And that's a very important topic in general, and certainly now in the Corona world recession. So I will just then switch to the slides. Here we are. Macroeconomics and global financial markets is basically about international banking, asset market dynamics, and monetary policy in the world economy. And if there is enough time, I might also cover some special aspects of EU Eastern enlargement. Okay, here we have an important disclaimer. Everybody is urged to respect the copyrights which we have here. That's of course quite important, and it is adequate that users and those interested here in the presentation should really stick to the rules. So one special required reading here is there was a special issue in the journal International Economics and Economic Policy in 2019. There was many contributions on Brexit-related financial market aspects. And this is all from a Bundesbank sponsored research project. There is one exception. There is also an additional contribution of Barry Eichengreen from UC Berkeley, who is looking at the impact of Brexit on the international financial architecture, quite important, of course. And I was actually also presenting recently the book, The Global Trump in the US, and it has, I think, some really interesting and important aspects also here for our topics. So here you have a YouTube link, so that is available. Basically, we will start with an introduction. We will look at some key concepts and, of course, lessons from the Asian crisis. That's a very interesting crisis, one may say. And then the link about macroeconomic global financial markets. It's an interesting question. If you want to liberalize the capital account, as China, for instance, has plans to do. And so what would you have to really consider within such a capital account liberalization policy, and which special aspects one has to take into account if there's also financial market integration, and we have some general macro policy issues. We also deal with, of course, stylized facts and important empirical findings. We are always interested in the theoretical analysis and from a European perspective, but not only from an EU perspective, financial market integration, economic dynamics. Sometimes global economic dynamics is crucial. Now, after the Corona 2020 crisis, one may raise the question, maybe we have had too much of financial globalization or other forms of economic globalization. In any case, we have had already a serious challenge in 2008 or 9, and that was the transatlantic banking crisis. So we should look at the links between the banking crisis and prudential supervision. And then there are also some policy issues for newly industrializing countries and the LDCs. So a brief look at some required reading. So I think the chapter 2, the World Economic Outlook 2016 is very important and interesting. So IMF often has interesting reports, or sometimes in the chapters of the World Economic Outlook. There is a nice ITSA paper by Prasad and Rayan. It's entitled A Pragmatic Approach to Capital Account Liberalization. There is the book, a preceding volume by myself, edited by myself and Cillian Ryan. So Cillian Ryan and myself, we had worked together in an EU project. There's an interesting paper which I very much recommend. It's required reading, actually. So Lindgren et al., Financial Sector and Restructuring, Lessons from Asia. So this is about lessons from the Asian crisis. It's an IMF occasional paper. There is also a special paper here from myself. It's 242 ERW paper, which you can download from our website. And then the already mentioned Brexit special issue in international economics and economic policy. It's the March issue 2019. Always a pleasure to read and very interesting. The Bank of International Settlements annual report, so in this case from 2019, and the Deutsche Bundesbank Financial Stability Report was chapter 5 from 2019. I think is also quite interesting because here the Bundesbank looks in a kind of a pioneering perspective also at new risks in financial markets, and this is all about climate-related risks. So some key points. Okay, financial markets, banks, insurance companies. We are talking also about investment funds and hedge funds. The latter are unregulated. They're all part of the economic system, are important in various ways. What is specific of financial markets, they have a high speed of adjustment, so they are relatively fast to good markets. And on the other hand, we have seen that financial markets and banks can be a starting point for serious crisis. So, in the US stock markets in 1929, so there was a starting point of the Great Depression, or the real estate markets and banks in 2008, which all started in the US, but the bankruptcy of Lehman Brothers, okay, on September 15th, 2008, that was a special date, but there were certainly links, particularly to the financial market developments in the UK. And okay, other EU countries also were affected. And if one takes a look at the economic growth after the shock of 2008 and 9, we can see that countries were not able to go back to the old growth path. So there was a downward shift in the growth path. We might well witness a similar development in the context of this serious Corona world economic recession. We'll see. Okay, banks and financial markets are crucial for investment financing. Question is which regulation for banks, for instance, we have, or how much deregulation, and just think of developments in the UK, US, and the EU, or in China. Okay, if we have assets in a portfolio, we usually talk about yield, the risk measured through the volatility of asset prices typically, and liquidity of assets. That means to which extent is it easily possible to sell at the going market price, and here we have considerable differences across various types of assets. Okay, major impulses in financial markets. Think about banks and other institutional investors, of course, technological change, technological progress, fintech these days. We have investors. Many investors have long-term investment project. Think just about the example of an infrastructure project. That's certainly a long-term project, and there are very basic rules from financing. And one would be that investment should be financed long-term. Certainly, if you have an infrastructure project now, which is a physical infrastructure which will be in place for half a century or maybe more, so then it would not make any sense to finance this with bonds of 1 year maturity. No, you would look for opportunities to get a fairly long-term maturity. So you want to avoid what is called maturity mismatch. If you have financed your long-term investment project through short-term bonds, then you have, of course, a rollover risk every year. So, and as the interest rate might all of a sudden increase, then you could be in trouble, and in the end, the project actually might not be profitable. Okay, we are interested in the stock market. Stock markets are very important in the United States. They are also important in the EU and China. In the EU, some countries are, let's say, more remarkable here than others. And Sweden, for instance, is a country where stock markets play a big role. And actually, many workers, directly or indirectly, hold stocks. Similar story you can identify in the UK and, of course, in the US. Corporate bonds markets. Again, more important in the US and in the UK than in the EU 27. Bank lending is very important in EU 27 countries. Things have changed a bit, I would say, after 2000 or so, when corporate bonds became more interesting. And these days we have not just the very big companies which all have a rating, and once you have a rating, you are active easily in the corporate bond market. Yeah, we have regulators. We have a certain influence of G20. So G20 became, let's say, quite influential in the context of the 2008 international transatlantic banking crisis. So G20 typically has links, of course, with the IMF, and the decisive actor actually in the field of regulation, then international regulation, is the Bank of International Settlements in Basel in Switzerland. Okay, there is the European Union, there are national governments. Government through fiscal policy, deficit spending, and then the development of the debt-GDP ratio plays a role, and of course is then active in government bonds markets. So we are interested in what is happening in country one. Say country one is the Eurozone, country two is maybe the UK or Japan or China, and then there is always the biggest financial market in the world, which usually is in the United States. Now we have quite a bit of stock market volatility. So the implied volatility here you can recognize from the VIX indices for the EU. For the EU, this is in blue. For the UK, this is in green. This is the FTSE VIX. And the red line is the Standard & Poor's VIX, so for the US. Yeah, all what you can see basically is occasionally there is a very strong implied volatility. So look just here the year 2009. Now, this is enormous. Of course, it was already an increase in 2008. And then we have a year like 2016, when we had the Brexit referendum, or actually the British EU referendum in June. And then you can see a green spike, and the green spike probably has spillover effects to the EU 27, or also in some cases maybe to the US. So that's always interesting to see how big is the volatility on stock markets. I would say that's still correct to assume that US stock markets are dominating. So if you look at financial market dynamics and challenges, let's say 2014 to 16, then we could see some new challenges, instabilities in China. So there was a lot of let's say noise in stock markets in China, and one probably sees there a structural decline in output growth. We see very low real interest rates, I would say in the years after 2008-9, in the US, in the UK, in the EU, in Japan, and Switzerland. That's a question then also for the development of the global savings rate. So maybe this will decline because there's a kind of a long-term fall of the real interest rate. And actually in the US, this goes back to the mid-1980s, or will it continue to be rather high? So maybe that global demographics, in this case increasing aging, is raising then the savings rate. So about 23% global savings rate for many years. China is a big player here. So the Chinese savings rate is very high to some extent because China doesn't have a broad social security system. Okay, China, of course, is also modernizing this part of the political system, and maybe that if government really establishes a broader social security system, then the private savings rate will reduce in China. There is also a cultural aspect here. So if you are not just from, let's say, Beijing, you are a young man and you would like to marry a girl, then your parents-in-law would expect that you should have already at least a small apartment, or you should have sufficient savings to buy in the near future a nice small apartment once you have married. So this is a specific Chinese aspect of saving. So relatively young men are observed to already show a fairly high savings ratio at that young age. Typically Americans or people living in the EU, young men in the EU, would have a much lower savings rate than their counterparts in China. Of course, a relatively low real interest rates brings rather high stock market price levels in the US and the EU. We have had also certain reforms of the US President Trump, 2017 to 19. But his plans, of course, go back to his campaign in 2016. And some of the reforms simply are reductions of the corporate tax rate, which also should normally drive up stock market price levels. And Trump made it much easier for multinational companies to bring back, let's say, profits from abroad. And with that additional liquidity, then many firms decided to buy back stocks, which drove up stock market prices very strongly in the US. Yeah, the situation, I would say 2015 to maybe 2020 is kind of unnormal. We see very low real interest rates in leading OECD countries. We roughly see that the normal interest rate of government bonds is 0 for a 10-year maturity, certainly for Germany, also France, certainly also Switzerland, and sometimes it's even negative. Okay, that's then the question, okay, how big is then the real interest rate? Okay, the nominal interest rate is 0, and we have, let's say, 1.5% inflation rate, then obviously you have a negative real interest rate. And profit maximization of firms requires that the marginal product of capital, MPC, is equal to the real interest rate, which in turn is the nominal interest rate minus the inflation rate, or if it is at the beginning of the period, we would say the expected inflation rate. Now, if the real interest rate is negative, one can have a lot of doubts whether or not we will have inefficient or efficient investment. Okay, if government can borrow at slightly negative real interest rates, that still doesn't mean that a typical small or medium-sized company in the US, UK, Germany, or Japan, or China could borrow then at negative real interest rates. There is still a risk premium, of course, on corporate bonds. We have seen a lot of QE policy, so quantitative easing. That means indeed that the central bank buys government bonds, and therefore the increase in the money supply, that is DM, is equal to minus DB, so B is the stock of bonds. And the ECB, for instance, has been active here with quantitative easing 2015 to 2020, before already the US central bank, so the Federal Reserve System, and also the UK were active actually immediately, more or less immediately after the collapse of Lehman Brothers, September 15th, 2008. And there was some fear that the recession in the US might be so strong that deflation could become the new problem, and therefore it was decided then that buying government bonds, which brings down long-term interest rates, and these then through a substitution effect bring down the short-term interest rate. So that was the kind of preferred policy approach to overcome the serious recession of 2009, but also then the fear of deflation. Okay, so if you have quantitative easing, what you typically get is you get a lower nominal real interest rate, and you get a real depreciation. As is shown in the Branson model, we will come back to that at some point. Okay, so or in a European perspective, in a Eurozone perspective, QE means the European Central Bank buys government bonds. And of course, the central bank pays with money, so the money supply will increase. You cannot conclude easily that let's say, a strong quantitative easing policy in Q1 or 2 automatically means that the growth rate of the money supply will increase strongly, because the central bank has many options to offset such a development. Yeah, QE was developed very much in 2008 or 9 in the US and the UK, only later in the Eurozone. And in the US, the head of the Federal Reserve System, Ben Bernanke, was, I think it was very professional in his monetary policy approach. It was not really possible to reduce the central bank interest rate easily, so the short-term interest rate easily in a kind of a conventional monetary policy. And therefore, they decided to switch to quantitative easing. And the Bank of England actually, after the shock of the transatlantic bank crisis, did more or less the same. And the story always is the interest rate goes down. You get a depreciation of your currency, and typically then as a kind of side effect, you get higher stock market prices. There's also an empirical paper, if you're interested, for instance, on the Bank of England's website on this. So here we can see the long-term decline of the US real interest rate 1980 to 2018. So this here is for a 10-year maturity. The inflation rate is measured through the change of the GDP deflator. So okay, the real interest rate in 81, 82, I would say, were abnormally high, because then the Fed had adopted a restrictive monetary policy because they wanted to fight the then very high US inflation rate. But with a grain of salt, we can say that maybe a normal real interest rate is about 4%. And then if you then look what has happened after 2009, I would say then the real interest rate is just at 2%. This is a bit surprising that this is so low. And the question is, does it come mainly from U.S. economic policy, U.S. monetary policy, or is there also a strong international element? For instance, the strong capital exports of China, and that means in a mirror capital inflows into the U.S. Here you have the gold price, again over a longer period, 1980. You have your daily data, and then we can see for a long time it's kind of stable, which means actually in real terms it's falling, but then you see 2006 onwards there's a strong increase. And then after 2010 there is a certain decline, and then again there is an increase of the gold price. The yield, of course, is zero at first glance, but of course if there is an expected increase of the gold price, well then this percentage increase is your yield on gold. So here you see the ratio of the gold price to the US GDP deflator index, and of course this, let's say, brings the gold price more in a perspective. Okay, we can still say that recently in 2012-13 we have seen a kind of a historical high gold price, real or relative gold price. Before it was very high in 1997 and 1980, so that is after first oil price shock, then also the inflation rates actually were very high. And if people substitute then money for gold, then of course one should not be surprised to see this development here. Okay, here we have the relative gold price and the relative crude oil price. As you can see, between 1986 first quarter, and then you can see that the two lines for a long time are kind of parallel. Of course, the oil price has then a spike, as you can see, in 2008 or so, and then it falls dramatically. Then the oil relative oil price line, the orange line, is then almost again parallel to the blue line. But then after 2016, the relative oil price has strongly fallen, and I think this largely reflects the enormous cumulative investment in renewable energy. If worldwide investment in renewable energy is very large, and if we have an increasing number of electrical cars, we just have started with that. Okay, maybe China is a bit ahead of us, but then of course the demand for oil and gas will decrease in the long run, and we have seen a kind of a shocking development actually in March 2020, when all of a sudden the oil price was down to zero, and in the future market there were even some contracts traded at negative prices. But here the problem was obviously that the demand for oil has enormously increased in the context of the global corona recession, and supplier countries, in this case the OPEC group and Russia and Mexico, could not quickly agree who should cut by how much the production of oil. And then then there was a serious problem in the oil market. And on the other hand, it's such an unusual event that oil prices go down to zero. So one can say that policymakers, and I would say in OPEC countries plus Russia and Mexico, did not really understand how big the challenge here of the corona world recession is. It's true that the oil price in nominal terms actually already has fallen once very, very strongly, and that was then in the context of the Asian crisis, when the nominal oil price for a short period fell below $10 per barrel. Okay, here we have in this case, the nominal interest rate, monthly values for UK, US, and the Eurozone. So the UK is the gray line, US is in orange, and the Eurozone is in blue. And we can see, I would say, a long-term parallel decline of the nominal interest rate. So I would argue that in recent years, which means in the decade after 2009, after the transatlantic banking crisis, we have seen a lot of kind of unnormal or new situations. So central banks, for instance, would buy government bonds. So this quantitative easing policy was adequate to some extent. It worked. On the other hand, there are constitutional constraints, and we should not forget this. So the ECB, for instance, in the Eurozone, has to make sure that it will not run into problems with the European Court of Justice, which, as it turned out, is, let's say, a bit generous in giving a lot of autonomy or discretionary room to maneuver to the ECB. The German Constitutional Court is stricter, so the Bundesverfassungsgericht it imposed a verdict on May 5th, and the German Constitutional Court argues with respect to the ECB's buying of government bonds. So this comes under the ECB's heading Public Securities Purchase Program, so PSPP. The German Constitutional Court argues the ECB has violated the principle of proportionality, and actually it also has to show, and it did not, that its monetary policy goal, so here the goal is to achieve an inflation rate below but close to 2%, is balanced with the broader effects of quantitative easing on economic policy. So it seems not to be acceptable, the German court says, that Germany would accept the ECB to simply buy a lot of government bonds and then not explaining exactly why certain amount of quantitative easing is adequate and what then also the QE policy has as side effects or other effects than on broader economic policy in the Eurozone. So I have taken a closer look at some of the issues, actually in the context of options to overcome the corona crisis, and the EIW paper 273 is available from the Institute's website. So we have a specific challenge. We can say since June 23rd, 2016, when there was the British EU referendum, which was lost in the sense that the Brexit majority was 51.9%. There is a very big challenge for the EU and maybe actually the Western world. So Brexit means that the second biggest EU member country is leaving the European Union after so many years, and the UK joined the community in 1973 along with Ireland and Denmark. And as it turned out, certain traditions and also Thatcher's deregulation of banking and finance in the 1980s in the UK, this has very much brought about a very strong role of London or of the UK to become here the wholesale banking center of EU 28. And it's kind of surprising, but it still is true in 2020 that probably more than 60% of the wholesale banking activities of EU 27 is in the UK. So that means that the EU 27 countries, that the EU should have a lot of interest that there is political and financial and economic stability in the UK. Maybe that Brexit, which was formally implemented on January 31st, 2020, that that Brexit will bring then more wholesale banking activities in Frankfurt, in Paris, in Luxembourg, in Dublin, and maybe in Amsterdam, in Frankfurt, but that will take some time to bring down the very high market share of the UK. So the UK left the European Union. Okay, they still are. The UK still is in the EU single market, probably just until the end of 2020. And one will see which type of future EU-UK free trade agreement we will get. Okay, to some extent, Brexit simply is a political decision, so we don't have to discuss this maybe very much. But on the other hand, I think it's a strange referendum. It was a strange political process, and I actually would say it's a disorderly referendum, because we can easily figure that the normal result with standard government information policy, in this case from the Cameron government, would have been a 52% majority for Remain, and you can read more about this in my book, An Accidental Brexit. I think the #1 Econ Brexit book, and it was published 2017 in London by Palgrave. The book has, I would argue, a lot of interesting aspects and some theoretical insights also. I will mention just one aspect. One critical question to be raised is, how is the interaction between, let's say, free international capital flows and the outcome of a referendum? And I think there is really an interesting challenge here, in the sense that, okay, if let's say a large majority of investors prior to June 23rd, 2016 had been rather skeptical about the majority pro-EU, then you would have seen a lot of capital outflows. You would have seen a strong depreciation, which would have scared many British voters to vote for Brexit. Instead, there was the paradoxical situation that obviously the majority of investors believe there will be a majority for Remain. So there was an appreciation of the British pound, and this maybe was taken as a signal by potential Remain voters. I can stay at home, because usually financial markets are very good in signaling economic or political developments. But I would argue in this case, financial investors were not very clever. They were, in a sense, misleading the public. So all I'm saying is maybe one should really consider the question, is it good to have free capital flows just in the week of a national referendum on such an international issue? If you want to have an unbiased referendum result, I would actually argue, okay, there must be a week without any international capital flows. Otherwise, you get strange distortions. And there's also the problem, of course, with the referendum, that the info policy of Cameron was really weak. The point simply is that that we can look for comparison at the Scottish EU referendum that was in 2014, and then the Cameron government did send an info brochure to every Scottish household explaining you will lose £1,400 and all the benefits of EU membership. Okay, that's a clear message, and the referendum result in Scotland was the Scottish wanted to remain in the UK. Now, 2 years later, there was then this British EU referendum, and of course, one would have expected, I would have expected, kind of a standard info brochure, which would say, okay, if the UK would leave the European Union, there will be a certain loss of income. Actually, there's a Treasury study available in April 2016 in London, and it says you will lose, in a kind of a standard scenario, £1,800 per capita, so that is more than in the Scottish referendum. And of course, I know all the benefits of EU membership, but in the 16 pages info brochure of the Cameron government, you find nothing on this. And on the other hand, based on a UK popularity function, which shows the link between economic growth performance and the popularity of government, well, one can easily calculate that if voters in the UK would have known this, then the result would have been 52.1% for Remain. So now, at this point, all I want to say is that, okay, Brexit is really a historical shift, a historical political and economic shift within the EU or within Europe, and it will have a lot of implications and effects in international financial markets. Okay, we have seen higher financial market volatility after June 23rd, 2016. The Johnson government came into place. Okay, at first, Cameron had to go. There was a new May government. There was a pound devaluation. But in the end, the UK leaves the EU on January 31st, 2020, and there is Brexit. So London as an EU financial center is losing ground. There are many jobs relocated, not just to EU27, but also to New York, because for some financial products, the second best place maybe for a US bank to service the EU27 market is actually is New York. And the point is simply that, okay, once the UK leaves the European Union, then the EU financial passport for banks in the UK is no longer valid after Brexit, unless there would be specific clauses on that in a future EU-UK free trade agreement. But that is quite unlikely. And if we would assume the UK-EU free trade agreement looks a little bit similar to what Canada has obtained in a free trade agreement, okay, UK will obtain better conditions at the bottom line, I would think. But in this EU-Canada free trade agreement, there is no single passport rule, so that means Canadian banks cannot simply offer financial services from Canada. So this single financial passport for banks was very useful for British or American or Japanese or German banks active in the UK. And you could indeed service then from this UK financial center in London all your clients in the EU 28 market. We have seen a temporary reduction of global output and trade growth in 2015-16. Actually, we have already seen some, I would say, reduction of trade growth after the transatlantic banking crisis. Now you can see this on some reports of the World Trade Organization. An important aspect is that a populist president, in this case Donald Trump, was elected in 2016. So Trump became the new US president in 2017, and his program was, I would say, to some extent typical for a Republican president. So he was reducing corporate taxes. He was raising government expenditures, certainly so for the military. And if you raise expenditures and if you reduce tax revenues, what you get is a big deficit GDP ratio. And this is exactly what you can see with most Republican presidents in the US after 1950 or so. So it worked to some extent in the sense that the US stock market performance was very strong. There was a rally in the US stock market, and this has spillover effects then to the EU, to Japan, and so on. This can stimulate higher investment and then higher growth. So one important aspect in the world economy, I would say, is the expansion of information and communication technology, or the internet expansion in North and South. That's still working. It's contributing to growth and innovation. We have global population growth, a bit more than 7 billion people on the planet in 2020, and the UN projection says roughly 10 billion in 2050. So that suggests there will be global demand growth in markets. On the other hand, we see when you look at oil prices, as already mentioned, we see declining oil prices 2014 to 17. So that was, of course, before the Corona world recession in 2020. It was it's very big shock. And I think one hardly can expect big increases in oil prices if we take the normal level of maybe $50-60 per barrel, which of course is not what holds in 2020. So the investment in renewables in 2015 was 4 times that in conventional fuel. These are figures from IRENA, which is an international institution specializing in renewable energy. All this stimulates output in OECD and China, and kind of a normal global growth rate is maybe close to 3%, at least as long as China has fairly high growth rates, and India actually also has high growth rates. In 2020, unfortunately, World Economic Outlook April of the IMF says we will have minus 3%. So that's of course a big shock. There's an expected peak of global oil demand around 2035. This is what I've seen in a presentation. From some, I would say, leading consulting firms. The oil peak is driven by global supply and demand dynamics, at least to some extent. There's this increasing effect of climate policy and investment in renewable energy. expected global oil peak is important in economic terms and in political terms, and of course the OPEC countries will have to adjust very much so that they could cope after 2035 with much lower oil and gas exports, possibly also with fairly low oil and gas prices. Now the situation, of course, has dramatically changed in the Corona world recession year 2020. There is a global recession due to this coronavirus shock. It is a kind of a symmetric shock in all countries. The oil price fell from $65 per barrel to roughly $20 in spring 2020. OPEC Plus have somehow then finally agreed to cut production, but it's not so clear that this is a stable cartel, because there is a strong incentive for several major oil producers which rely on the government revenue side very much on oil and gas production, on revenues in world markets. So some of these countries might simply try to ignore the OPEC Plus agreements on reduction of oil production. The oil price, incidentally, has, of course, an effect on the CO2 certificate price. That's very interesting. And we have emission trading systems in the EU, in California, in China, in Korea, in many other countries. And if you're interested, again, just take a look at our EIW working paper series. I wrote a paper with Khan Chalabi on this, and we have a lot of interesting insights. Okay, the situation 2020, global recession. Okay, the UK and the US, they have a policy mix which is very expansionary. To some extent, it's kind of a traditional policy mix, you might say. You have expansionary fiscal policy plus expansionary monetary policy, but the situation again in monetary policy is a bit special, because the interest rate of central banks is now down to zero. In the Eurozone, it was already at zero in 2019, but interest rate reductions of the Fed and the Bank of England in the first quarter 2020 brought down the interest rates. They are also more or less down to zero. And then the next step is then, of course, again, quantitative easing. So if then the Bank of England and the Federal Reserve system respectively are doing such quantitative easing policy or adopting such a policy, then they buy government bonds. This drives up the market price of government bonds, and therefore the interest rate, the long-term interest rate, goes down. And this particular policy mix, I would argue, brings kind of an anchoring of the nominal interest rate, market interest rate, very close to zero for maybe 2 or 3 years. In the Eurozone, things are a bit different. You also have an expansionary fiscal policy, but there is no Euro fiscal union, so you have 19 member countries, and therefore you have something maybe like a coordinated fiscal policy of Eurozone member countries. Okay, there is an EU fiscal policy package which comes on top of the national expansionary fiscal policy measures adopted by individual Eurozone member countries. But as I said, the interest rate already was zero, the interest rate of the ECB in 2019. So therefore the ECB has, among other things, restarted or enlarged its quantitative easing program. They have adopted what they call pandemic QE, The volume is 750 billion euro. But on the other hand, we have obviously no such thing as the Eurobond in the Eurozone. And that means that the situation in the Eurozone in qualitative terms as regards the policy mix is different from what it is in the UK and in the US. And I would argue that there is a considerable risk of a new euro crisis too. Actually, we have had a euro crisis in 2010 to 14 roughly, which meant at that time that Greece and Ireland and Portugal had lost the access to international capital markets, so that government deficits could no longer be financed. You could not roll over the stock of government bonds. And therefore, EU countries created special rescue funds, and there is one rescue fund still well alive, is the European Stability Mechanism, the ESM, in Luxembourg. There is now, I think, the risk of a new euro crisis too, and the epicenter would probably be Italy. Italy has a very high debt GDP ratio already of 135%. And with Italy, there are some problems. One even could not rule out that all of a sudden there will be a referendum on Italy leaving the EU, and then maybe you get Italexit. Certainly, a majority of Italians is quite frustrated by the coincidence of the high number of coronavirus case fatalities in Italy, which is really very high, and the massive recession. And we haven't seen most of this dramatic recession, which everybody expects to fully become visible in the second quarter of 2020. So one problem with Italy is that it has a debt GDP ratio already of 135%, and at the end of 2020 it probably will be close to 155%. And if Italy would lose access to international financial markets, that will be really dramatic. How likely is this? That's not so easy to say, but what we see is that both Moody's and Fitch, two rating agencies, have put the rating of Italy's debt downward. This latest was Fitch. So on April 28th, they published on their website a downgrading from BBB to BBB minus. So this is just one notch about investor grade rating, or if there is a further downgrading by Fitch, then Italy's debt no longer is investor grade, and then, for instance, Italian institutional investors, banks, insurance companies, they would have to sell, and this is based on existing regulations. Certainly the insurance companies, they would have to sell Italian bonds, and this of course would reduce the price of Italian bonds, and this would then increase the market interest rate probably dramatically. And the only good news for Italy in late April 2020 is that Standard & Poor's, which is the biggest rating agency, still is 2 notches above the non-investor grade territory for the case of Italy. So if we talk about interest rates or government bonds or corporate bonds, okay, then the benchmark typically is a AAA government bond from, what should we say, Germany, Netherlands, maybe also Austria or Finland, UK, US. But US already was a question mark, because my anticipation is that the US will have a very large deficit GDP ratio in 2020. They had already high deficit GDP ratios of about 4% in the economic upswing under the Trump administration, which is unusual and actually economically it's inadequate. You should have a very low deficit GDP ratio in an economic upswing. And if the deficit GDP ratio in 2020 is rather high in the US, then one can anticipate that by 2025 the US debt GDP ratio will be close to 160%. It's 100% at the end of 2019 or the beginning of 2020. And the US already lost its AAA rating with Standard & Poor's in the aftermath of the transatlantic banking crisis. And I cannot imagine that the US still will have a AAA rating in 2025. So the problem simply is, as we have already seen a couple of years ago in the Euro crisis, in the case of Greece, once you have a very high deficit GDP ratio, so in the case of Greece that was 15%, and in the case of the US in 2020 that I think might be even higher, and then you have a serious problem if you already then have a high debt GDP ratio. So Greece in 2010 already had 110%. And then, the government was trying to hide the size of the deficit GDP ratio. In Europe, normally in the EU, that should not be more than 3%. Okay, if there's a strong recession, you can have a bit more. But the point is, let's say if you have 15% deficit GDP ratio, well, we know that this is, I would say, insight from economic history, that the country typically cannot reduce its deficit GDP ratio by more than 3 percentage points per year. And therefore, you got, in the case of Italy, then you could expect as a market actor that Greece will have 15% deficit GDP ratio, then next year 12, then 9, then 6, then 3, then 0. But if you add up all this, then you have an increase of 45% in a few years. So the debt GDP ratio goes up by 45%, and the US is in a very similar position, and possibly the deficit GDP ratio in 2020 will be even higher than 15%. The Congressional Budget Office, in a study which was published before the Corona crisis, they had argued that continuation of the Trump deficit policy would mean that the US would have a debt GDP ratio of 180% in 2050, which sounds all alarm clocks, I would think. But of course, 2050 is far away, market investors were thinking. But I would argue that 2050, or the bad news of very high debt GDP ratios of the US is not so far away. Okay, what do we know about spreads? So let's say the difference between we can take maybe Greece, between a country which has a fairly weak rating, so let's say has triple B. Let's say the interest rate is 2%, and then for the AAA rated country, in this case maybe Germany as a benchmark, the interest rate is 0. Well, if you have risk neutral investors, one can simply show that the difference in the market interest rates reflects the expected probability of default of the BB country. The risk premiums maybe in the Eurozone are a bit distorted now because the ECB has bought a lot of government bonds from Eurozone member countries. Usually there is a limit. The ECB would not buy more than 1/3 of the outstanding stock of government debt of any Eurozone member country. But in the dramatic Corona shock year 2020, the ECB has changed this limit, and they occasionally have bought additional government debt, so that more than 1/3 of the outstanding debt is in the coffers of the European Central Bank. And there are, of course, also corporate bonds. And again, we can take then a look at the risk premium, and this we would now define as the difference in the interest rate of a AAA rated company's bond and the government bond interest rate here of the country which has, let's assume, AAA. And you will typically see that there is a higher interest rate for corporate bonds. That's normally always higher than the interest rate for government bonds. We have seen some exceptions in recent years in Italy, where some big Italian multinationals could raise capital in the market, could sell bonds at an interest rate which was slightly below that of the Italian government, but that should be also a clear warning signal to the Italian government or Italian governments, because governments in Italy unfortunately are kind of short-lived, and maybe many of these governments have good reform intentions, but if you're in power just for a year or maybe a bit more, it's not so easy to implement a, let's say, growth-friendly, pro-growth economic policy in Italy. Okay, so if we have then specific events, for instance, such as the Brexit event, so in this case, the British EU referendum in 2016, then it's interesting to see, okay, how is the effect then on corporate risk premiums in the UK, in the Eurozone, and this was one of the questions we were dealing with in this Bundesbank-sponsored research project. So here you have two graphs from the BIS annual report 2016, and again the message is that the policy rates, as you can see, have been declining and very low in historical standards and historical perspective, and also the 10-year government bond yields here for the G3. This is really very low. It has here hit the 0 line, so we have a slightly negative real interest rate. So the situation has not changed between 2016 and 2020. So we are living in a low interest environment. To some extent, this might actually reflect economic globalization. And of course, then certain people will have an advantage if the real interest rate is so low. Certainly companies, certainly governments, whoever is a net debtor, is in a net debtor position as a sector, as a company, and so on, has an advantage. The question is, does everybody have an advantage? And here we can raise some doubts because, for instance, if you're an unskilled worker and you think, oh, I could now benefit from financial globalization bringing very low real interest rates, that's not so easy for an unskilled worker or for poor families. If you go to the bank and you would say, yeah, I would like to buy a house or an apartment, so why don't you give me 150,000 euro loan at a very low interest rate? Okay, if you are a skilled worker, or if you already are rich, if you have wealth, then that should not be a problem. You go to the bank, you will get this loan maybe of 250,000 euro, and then you can buy an apartment or a new home. So here, in the second graph, you see the longest maturity of government bonds trading at negative yields, and that, of course, is also something which is unusual. We have several countries which have negative yields, and you can see then how big the maturity of those bonds with a negative yields, how big it is. And you see many countries here. So this is an abnormal situation, and probably it's not really good for economic efficiency and economic growth in the West if we have negative real interest rates for a long period. Okay, here we have another graph which shows the contribution to potential output growth, and you have this for the US, for Japan, for France and Korea, and the right-hand graph. Yellow is total factor productivity growth. You have then the contribution from capital, which is in blue, and labor, which is in red. And what you can see is, potential output growth seems to be declining over time, and that goes here from 1980, 70, 90 to 2011, 15, which is the latest bar. And I think it's fair to say that there is a decline of total factor productivity growth, except for Japan. Similarly was capital, and maybe here we already see a story that the real interest rate is so low that many investment projects are realized which are kind of doubtful and do not bring much impulses for economic growth. Labor in the US is declining, in Japan is declining, and actually has become negative over time. In Korea it's declining. In France the picture is not so clear, but of course the aging of the workforce could be a problem here, and will be interesting to see whether or not Western economies as well as Japan and Korea can come back with higher growth rates. And we should raise this question only after we have overcome the Corona world recession. Okay, London as a EU and global financial center, absolutely clear. We have very powerful, very impressive, I would say, financial service providers in London. They are strong in risk management, corporate bond placement, almost everything. Now, if the UK then leaves the EU single market, okay, who will offer these services then in the future for the EU 27? Okay, you can of course say if you are a German, French, Italian, Spanish, or maybe Dutch multinationals, you could still say, okay, when it comes to certain services, I always will rely on banks in London, on banks in the UK, but now certain things have changed, because once the UK is no longer a member country of the EU, then of course the EU regulations for financial markets are no longer holding, and maybe we will see in the future a very different regulatory policy in the UK than in EU 27, and maybe this then brings more financial instability to the UK banking system and so on. So there is in any case a problem that we have to anticipate, that some of the services no longer are available at very cheap terms. So maybe there is a substitution service from either maybe German, French, Dutch, or British banks located in the EU 27. But London is a place, as a financial center, which has a lot of financial markets, positive externalities, big market externalities, and maybe that Frankfurt as a financial center or Paris is not a very good substitute of what you would what you could get before in the UK. Okay, so one interesting question then is, does the EU or do the EU 27 countries really timely encourage the provision of new key financial services post-Brexit? If the answer is no, then there are new risks. If, on the other hand, there are certain incentives of governments and maybe also the EU Commission to encourage provision of new services in EU 27, you cannot be so sure that we easily can find very skilled prudential supervisors. So then you, in any case, will have for a certain transition period a specific new risk problem. And finally, we can look here at the EU and the Euro 25 perspective. Looking back a little bit at the Eurozone problem, I would argue we still have a kind of an unsolved Greek problem. It is true that Greece has returned to economic growth in 2018-19, but in 2020, I think there will be, of course, a big recession in Greece, and as so many different Greek governments all had very serious problems in coming up with a consistent and, let's say, convincing economic policy in the period 2008 to 2017 or 18. So then I would think Greece has a constitutional problem. This is not just, okay, you change government or there's a new party in the coalition and then things get so much better. But Greece has an unsolved constitutional problem. There is the expert group, the so-called the Venice Committee from the European Council, who could give some advice if somebody wants to listen to any advice. And with Portugal and Spain, we do not really know, and Italy is maybe a new case of new problems. So, the Brexit referendum has left, I would say, a lot of nervous market reactions, and things have improved over time a bit, but not in a decisive way, I would think. It still is unclear what is the future way of cooperation between the EU 27 and the UK. And there are new problems in Brazil, Russia, India, China, and in the OPEC countries. Okay, it's not a problem if some countries have some problem, but the Corona world recession makes things really difficult. India at some point looked quite good, so India was trying to catch up with China, to put it that way. They had high growth rates of 6 to 7% for several years, but now India, of course, faces very big challenges in the context of the Corona world recession. Fiscal policy room to maneuver is rather weak in the EU. There are still many countries which have high debt GDP ratios. Fortunately for Germany, we can say the German debt GDP ratio was back down to 60% at the end of 2019. So 6% is a kind of a limit which the EU would like to impose on Eurozone member countries. We have a Stability and Growth Pact, which says you should not have more than a deficit GDP ratio of 3% and a debt GDP ratio of 60%. Okay, France and Spain in 2019, they stood at around 100%, and as already mentioned, Italy 135%. In Germany, on the other hand, we have seen the rise of populist parties. The right-wing Alternative für Deutschland, so the AfD, is in the national parliament and in the parliaments of all states. That sounds almost as if there are some political currents which are also anti-EU and pro-neo-nationalism, like in the UK. And I think that actually Brexit is a populist political project. In Europe and also in the US, we have had banking reforms after the Great Recession, so after the transatlantic bank crisis. The banking system is now more robust, I would say. We have new rules from the BIS for big international banks. So instead of Basel 1 and 2, we now have the Basel 3 rules. So it says more equity capital, so banks find it easier to absorb big losses. On the other hand, if in this case from the real economy, the Corona shock brings problems for companies, which then can no longer easily repay loans, then there will be a spillover, of course, from the crisis in the real economy into the banking sector again. Okay, this was then our starting point, and we'll then continue and try to understand what is happening in these world financial markets, which policy options we have, and all these questions.